Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the amazing Anna Kelly. How you doing, Anna?
I'm doing great, Michael.
So one of the things that you and I have been talking about for, I'm going to call it 9 months, if not a year, is there's going to be some tremendous opportunities in the multifamily space. We're going to talk commercial here, not residential. So five and above, um, and really in your area, right? I've never done units above 40. You've been a part of many syndications and your own investments in JVs above that. And the one and only Grant Cardone held a small group meeting with some investors from across the country. A buddy of mine is in that. And I want to read to you a quote that he got from Grant. You ready?
I'm ready.
So 1,457 multifamily properties don't meet DCR requirements today. And what
Hmm.
does that mean for you? Today is reported that real estate data provider TREP, TREPP, haven't checked them out, has 1,457 multifamilies in their database currently do not meet or barely meet the 1.25 DCR requirement on their loans. This is bonkers. Keep reading. This means that for a strong, experienced sponsors who are not tainted by forced sales or foreclosures, there will be more opportunity to purchase multifamily at attractive prices than we have seen in a very long time. Now is your chance to get ready for the opportunity ahead, not in 2023 or 2024 when those deals start to hit the market. The potential is way larger than merely 1,457 properties identified by TREP. There are some 1 trillion, that's with a T, of real estate loans that mature in 2023 and 2024 across all flavors of commercial real estate. And a substantial amount of that is multifamilies. These properties will need to be refinanced with higher interest rates and higher cap rates in an environment that existed than an environment that existed when the debt was originated. Extend and pretend won't work as well as last crisis because interest rates are rising, not falling. And they were as they were in the aftermath of the great financial crisis. I'm excited. Now we've got the big Grant Cardone saying there's lots of opportunity coming. So, what do you take from all of that?
Yes, so I read the same article. It was kind of making its rounds, several different times, and I agree that there is going to be some pain ahead, which is opportunity for us multifamily syndicators that have the liquidity and the experience to take them down. So basically what he's saying, and this is what a lot of investors don't realize unless they do commercial, right, is we don't get these 30-year fixed loans. We get loans that are amortized over 30 if they're, great loans. But generally, we lock in a loan rate of about 5 years. Sometimes that could be 7 or 10, depending on the deal. But at the end of that 5 year period, you either have to refinance or the rate adjusts, depending on the loan type. And either way, if the properties were bought, let's say in the last 4 years, they were bought at, generally speaking, low interest rates. Now, I'm going to temper this a little bit. First, let me just say this. The challenge here is that when they talk about DSCR not being met, what they're basically saying is that when you have a commercial loan, the lender doesn't just give you the loan once and say, oh, you're good, just keep paying and no problem. They make us provide financials either quarterly or annually, depending on the type of loan, showing our profit and loss statement and our balance sheet. And essentially, we have to be able to show that the net income after all expenses is at least approximately 20 to 35% above whatever that mortgage payment is, because the banks want us to have profit on top of just barely getting by. And that's called that debt coverage ratio. How much is the net income above the debt on the property? And in our loan covenants, there's two things we have to maintain: loan to value. So if we borrowed at 75% of the value, every quarter, every year, they're going to say, is the value of that property still sufficient such that the balance on the loan is no more than 75% of the value? And then the second thing is the income that it's generating sufficient to cover whatever that debt coverage ratio was that the banks required, usually between 1.2 and 1.35. So the worry here is that as rates go up, the mortgage payment goes up. So the debt coverage issue is if my mortgage payment goes up 50%, and my income doesn't go up accordingly to cover that increase in 50%, which is really hard to do, right? In certain situations, depending on how it was bought, then suddenly my net income isn't still 120% of that loan payment. It might barely break even. Break even and paying on time for a commercial loan isn't good enough. You have to have a slush. So there's this risk that if you hold the property, the loan can be called because you're not bringing up in enough income. And if you've got to refinance it, you may not be able to refinance it for the same money that you could before. Not only can you no longer get 75 or 80% of what it's worth today, you might only be able to get 60% of what it's worth today because of the credit squeeze due to this environment. So the real challenge is those that have loans coming up, they may not be able to refi or sell because if values come down, they can't sell for what they want. And they're going to be stuck in a couple of situations. They either have to get a capital call from their investors. Hey, you got to give us more money so that we can pay down this mortgage and not lose the property. Or they're going to have to sell it potentially a loss. Or they're going to have to move into bridge debt, which may be possible, right? But there's risk there. And so, yes, it's a real serious issue. Now, the one thing I will say is for those that are buy and hold investors that way overpaid and they really didn't have much meat on the bone to force the appreciation. What I mean by that is we go in, we renovate units, we put in a bunch of money, we raise the appearance and quality of the rent, the unit, we get higher rents, and therefore we force a big appreciation. The thing I'm going to temper all of this fear with a little bit is that people who bought in 2017, 2018, 2019, if they bought value add deals, they may have created millions of dollars of additional value in that property, meaning they'll be able to refi. They may not be able to get the profit on the back end they were hoping for, but if they've created a substantial increase in that value, even at 60, 65% LTV, I think a lot more are going to be safe than that trillion that are coming due. It really depends on how good was that operator in forcing that appreciation, getting that higher value, and getting rents up significantly substantial to be able to cover the increase in that debt coverage ratio.
Yeah, I think when I read that number of $1 trillion, again, it was commercial, not multifamily only.
Right.
I've already had some research into office, like San Francisco, right? It's been
Yeah.
decimated. Like there are buildings there that aren't 40% occupied, like most of downtown. Right. So there's going to be a lot of pain in office, a lot of pain. I expect some vulture funds, Blackstones, and all of
Absolutely.
those folks just to go to town.
And some industrial as well, because a lot of these
Yeah.
industrial buildings were bought for warehouses to stock supply, and now that's not needed. So I expect those two, retail, industrial, are going to be hit much harder. I think for multifamily, the other thing that we have to just kind of remember is that there's multiple classes of multifamily, right? There's Class A, Class B, Class C, Class D, which is war zone properties that you don't want, right? But those historically, statistically, when you're moving into a recession, when you're moving into potential financial crises, what's really interesting is Class A multifamily or Class B that's in a Class A market, like Houston, Texas, Dallas, Texas, Atlanta, Georgia, Raleigh, North Carolina. The cap rates on those properties, Michael, actually go down. Why? Because when there's volatility in the stock and bond market, multifamily is considered a flight to safety. And that's why so many institutions bought these things at crazy low cap rates at 3 caps, 4 caps, because they were basically making a move to an asset that they believe is recession resilient and safe during volatility. And so Class A multifamily, I'm really not that worried about, because if someone has to sell, they're still selling to an institution that's trying to flee the stock and bond market, and they're going to be okay. Class B, strong market,
I want to talk about that a little bit, the Class A for a minute.
Yep.
So I agree logically and historically, but again, I think we're in an environment that, for 40 years, rates basically went down.
Right.
I think we're, like we talked about in video 1 today, I think the next decade we're going to have structural inflation, which means I think rates will stay, I don't know, let's say above 5% for most of the decade.
Yes.
Right? And now if that's true, that means the 10-year treasury is probably 3.5, 3.7, right? Just using normal spreads.
Right.
I think there's going to be a lot of less 3 caps in the next 5 years.
I agree with you. But if we're just talking about like loans coming up in the next year or two,
Okay.
That's different than long term. Where will treasuries be? What's that risk premium that's going to be demanded for ABC, right? So let's assume for a minute that the rates go up to, the Fed gets the Fed fund rates to 5. You can go listen back to our first video, right? Yep. And they crush inflation and they bring them maybe not as low as what they have been. I don't think we're ever seeing those low rates again, but let's say they bring them back to, 3.5 or 4, right? Okay. If they bring them back lowish and get us close anywhere between where cap rates were 2018 to 2021. Okay. I think that Class A multifamily is still going to be really strong. There's still going to be an increase in cap rates across the board. I have no doubt about that because I don't think we're ever going back to the low rate environment that we were in. So my point is, if somebody's in trouble now or in the next year, while there's still this volatility in question, Class A is going to be much safer to be able to exit or find somebody that wants that property. Class B is in a major city with a really strong, robust economy. And I'll give you an example. I've already closed this deal, right? So I'm not raising money for it anymore. But we had a deal in Raleigh. Raleigh has the number 4 GDP in the nation. So, compared to every other major city, if you're in like one of the top 5 cities that's still producing better than we are nationally, those kind of resilient markets, there was $1 billion of institutional investment into Raleigh for multifamily this year. So that's the kind of market I'm saying is strong and resilient, where institutional investors are looking to be, and the jobs are really good. A lot of these syndicators, though, over the last couple of years were chasing yield, and they went to small tertiary markets like Oklahoma City. I like to pick on Oklahoma, right? Hoping that they could just go in and update the units and get great rents. Well, Oklahoma City has a 14% historic vacancy rate. You're not going to fix that with one sexy apartment complex, right? No. So those that kind of chased yield or in less strong markets, if you're in a Class A or B multifamily property in those less strong markets, you're going to struggle more, right? So it all comes down to the quality of the market you're investing in and the quality of the asset that you have and how well you have been able to perform since you've owned that asset. There's going to be many people that are going to be able to get out of this, but for those that can't, there is going to be tremendous opportunity for us that are still buying to be able to come in and scoop those things up at a very, very low basis and be able to hold them and ride out, whatever's coming in the economy.
Yeah, I think really when I read that, it's like, Anna and I have been talking about this for a while. There are going to be opportunities to move. And, that takes preparation. We've been preparing for 9 to 12 months on purpose, sitting on cash, even though some people say cash is trash, because we knew what was coming. We sold some assets, refied some stuff, got our debt structure right. So we can be opportunistic. I see great opportunity in the next 18 to 24 months, even though I'm focused on one market. There will be people that overpay that need help and have those banking relationships that they can say, hey, you want to step in? You want to do this? You want to do that? And then kind of the last thing to talk about here is, if I were to take residential and commercial and have them be separate over the next 2 years, my opinion, you please disagree with me if you do, I think there will be more pain in commercial given the debt structure and unrealistic assumptions than residential. Residential as a class, 98% 30-year fixed rate debt, everybody, 90 whatever percent below 4. When I look at those two and say, where's the pain going to be greater? It's commercial. What do you think?
I agree with you completely. And a lot of it's because most residential loans are locked at a fixed rate below 4%. And I've seen different stats, but it's, 85 to 90% of loans are below 4%. And so if people don't have to move, they're not going to. And so you're not going to have a huge decrease, even though the news is every day saying real estate's crashing, right? It's transactions. You're not going to have enough people that are willing to give up that nicer home at a lower rate. And for them to sell, they've got to pay more money either in rent or a less quality, smaller asset because of where mortgage rates are. And so you're going to have not a huge string of supply in most markets. And that's going to keep, the supply down, will keep prices up a little more than what they might be if they had all this crazy, variable debt. Just one kind of interesting point I was reading that really shocked me is that in the UK, they don't give you fixed mortgages. They're variable debt. So they're about to have a major housing crisis like we had in '08 because
Yes.
almost all of their homes are done on variable rate mortgages. We don't have that here in the US in residential, and that's going to make it much less volatile than those that have variable debt, like those residential there or like commercial real estate.
Yeah, there are three countries that I've been following for about a year that just do arms. And for 40 years, arms were the right answer,
Right.
right? The rates were going down, generally speaking, and your payment went down. Not so much this last year, and probably the next 3 to 5 years of what we see coming is true. It's Canada, the UK, and Australia. All three had crazy housing. All three affordability is below the United States. A
Right.
lot of that was because of the debts was getting increasingly cheaper. Well, that's not going to feel very good for the next 5 to 6 years. They have these things. They have these things on in Canada called trigger rates. So think about this: you're in a 5-year arm. You have a 5-year arm at 1.5. They have mortgages with a 1 on it.
Wow.
But it buried inside the loan, there's this little carve out that says if rates get to 4, we have this thing called a trigger rate where your payment's going to go up. You have to. So it's not even a fixed arm, right? There's this little clause that says, if A, B, and C happen, trigger rates, it's crazy. So I think Canada, UK, and Australia housing markets are in trouble because of the debt, and that's what we learned
Right.
from '08.
Right. Right.
Crazy.
Huge opportunity potentially for those that are in those
Potentially.
markets, right, to buy properties at lower basis. So I can tell you this: I am a diehard multifamily investor because I believe in the fundamentals in the right markets, in the right areas with the right debt, right? But I have been the last 2 days searching for some single family homes on realtor.com, right?
I got 2 out of the MLS, realtor.com in the last 6 weeks. 2. I didn't
Yeah.
get a deal out of the MLS in 3 years. I got
And
2.
look how many have major price drops, and they're all sitting there with 20 or 30 of them that can't get the right price, right? So I'm like you. I'm excited. I'm opportunistic. I sold a bunch, and let me just tell you, after I sold a bunch of properties in 2021 and 2022, there's part of me that's like, why did I sell those? Why did I sell those? I should have kept them, right? Because a lot of older, wiser investors will say the worst thing I did was sell the properties. But why did I sell them, Michael, for this exact thing we're talking about on this show? Because I looked at all of my debt and I said, what will my debt coverage ratio be if my rates go up to 5 or 6, right? Not even thinking 7 at that time. What will my loan to value be if there's a softening because of inflation being high? And I figured out that I might have to come to the table with $1 million, right, on my property, on the ones I own alone. So
Right.
sold enough properties to get $1 million in liquidity just for that purpose, so that I had that safety. And yes, I sleep well at night knowing if this happens, I'm safe and I'm secured because I saw it in advance and I made those decisions. But there's part of me that's like, man, I shouldn't have sold them. What if it's all fine? And, I'm going to regret that I sold them. But now there's tremendous opportunity as well.
Yeah.
And so, there's always safety in having liquidity. I'll say that. I didn't believe that early on. And I spent every penny I had on the next investment and the next
And then some.
to continue to grow, and then some, right? Other people's money, banks' monies, all the debt I could get because debt was cheap and we were riding a cycle up, right? But you kind of watch these cycles and you go, there's a time to sell and there's a time to buy. We sold when we needed to sell, you and I both. There's all these issues coming for those that really didn't plan ahead. We're hitting a bottom. You're going to have an opportunity to make some tremendous investments and make back any money from the properties that you sold that you wish you hadn't, right? That's what I'm telling myself every day. And I believe it. And so I'm very excited that there's going to be better opportunity to buy properties at a better basis than what we've ever seen. Even with rates higher, we can always refinance that debt later.
Yeah, people this is your and I's third recession as really adults, right, in the game. And wealth is made in recessions. Income is made in the good times when everybody's making money. It's easy.
Yes.
That always makes me uncomfortable, right? When you're, shoe shine person, to take a Wall Street analogy, is making money flipping houses. I don't like that. But recessions, that's my time. So got the debt right, raised dry powder, and I'm already executing. Already got 2, still looking for more. Already told people I'm willing to pay 12% interest only on private money if the right deals come up. Because again, cost of debt doesn't bother me. I just put it in
Right.
the spreadsheet and see what comes out. So
Right.
I'm
And
ecstatic.
interest only, your payments are much lower than a fully amortized principal and interest at a lower rate.
Absolutely right. So Anna, where can people follow you?
Great. You can find me here on my channel, on your playlist. You can find me on social media at Anna Kelly, REI Mom. If you're looking for coaching and masterminding, my website's reimom.com, and passive investments in multifamily for accredited investors can find me at greaterpurposecapital.com.
Awesome. Thank you so much.